Can you guys roll my first slide for me? So everybody's here. I want to ask you a question. Show of hands. Who is investing in real estate? Who want to invest in real estate? That's good because real estate is magic. Okay, it's magic. So I want to thank all of y'all for coming here to see me. Yeah, I know you didn't come to see me because you don't know who I am. I had a great introduction, but my name is Vonda. And I have a small boutique firm in Atlanta where we teach tax and wealth financial education. So like he said, I have a franchise with Tom Wheelwright. He's my mentor. And Tom Wheelwright, as you know, is Robert Kiyosaki's accountant. And Robert Kiyosaki wrote Rich Dad, Poor Dad, right? So that's great. So I'm here in 15 minutes to tell you some tax planning things. So I'm not going to get to all. But as I tell you them, I want you to know there's one thing that I did not put on the slide that you all need to know and need to do in your business. And if you don't do it, everything is going to have a problem when you come to taxes, okay? But I'm not going to tell you right now. But let me ask you, who wants to hear what that is? Raise your hands. Good, because you're going to need it. Could you flip the next slide for me? So we talked about this already. We have people, Robert Kiyosaki said there's 4 ways to make money. Your employee, you're going to make 40%, pay 40% tax. Your self-employment, you're going to pay about 60. And people are like, why are you going to pay 60? Because when you're an employee, your employer pays half of the self-employment taxes, which is 7.65%. When you're self-employed, you pay all of it, which is 15.3%. And then you have the business people. This is big business. They're corporations. They pay 21%. And then professionals, investors can pay about, I'll say, they can go down all the way to 0. And that's what we're going to talk about today because you are all professional investors. Please ignore the mistakes that happened. I got into here and I realized I didn't have my slides. So I stayed up till 4 o'clock in the morning to reproduce the slides. So that percentage is missing a percentage number. Could you flip it for me? Now, we all talk today about poor people, middle class, and rich people. Now, as you said, poor people, I want you to know, is not necessarily poor. As he said, some of the people I know make a lot of money, but they're poor, and it's because of their spending habits. Poor people, they get income, and that income goes right out the door. It's like it's just walking. They don't know what happened. They made $50,000 last year, and they don't know what. They just put it on expenses. You know these people. They got a lot of stuff, but they have no money. And then middle class, and this is all a mindset, guys. This is not necessarily your income. Middle class, they get money, they put in liabilities. And you say, what is liabilities? They got 3 Mercedes-Benz, okay? They got a boat. They don't even know how to swim, okay? They got the biggest house you've ever seen, and there's only one person, 6,000 square feet. That doesn't make you money, honey. That's not money. That's liabilities. The rich people, they make their income. They put it in assets. They take that asset. They make their income. They put it in an asset. They make their income. They wash, rinse, and repeat. And we're going to talk about that today, how you wash, rinse, and repeat. Next slide, please. So in real estate, there are five top things that are magical. 1, self-employment. There's no self-employment taxes. You know why? IRS says you're not a business. Now you better run your business like a business, but you ain't a business to IRS. So there's no self-employment tax. That's 15.3%, ladies and gentlemen, you ain't paying, okay? Then you have deduction of expenses. We're going to talk about that. We have depreciation. Depreciation is like a gift from God when it comes to your taxes, okay? Then we have lifetime exchanges. Have you ever heard of 1031 exchange? Anybody? 1031 exchange? Great. And then we have debt. A lot of brown people don't like debt. They don't like it. I'm here to tell you, debt can be your friend if it's managed correctly. One thing I didn't put on the slide is I want you to know that government, the IRS codes tell you how to save money. People don't believe that. They believe the IRS codes tells you how to pay taxes. No, it tells you how not to pay taxes. And the reason that does it, government wants you to do certain things they can't do. They can't employ people. Businesses have a lot of tax deductions, so they want you to put your money there. Farming. They can't feed everybody. So farmers, they get a lot of tax deductions. I'm going to talk about depreciation. Farmers, depreciation farmers is like on steroids, okay? And then we have oil and gas. They need energy. You guys are in Texas, you know oil and gas get a lot of deductions. And this one is where you come in. They need to house the people they have fed, given energy and given jobs, real estate. So real estate gets deductions out the wang wang. And it's for you to know how to do it and do it right, okay? Next slide. Deductions. Especially when you're starting out in business, you hear a lot of people say, yeah, man, I'm going to get business. I'm going to get a business. I'm going to deduct every single thing. I'm just going to deduct it. I'm going to have zero taxes. Sometimes it happens. A lot of times it doesn't. A lot of times when somebody shows me they have zero taxes every single year, I look at their tax return and say, okay, who got the bail money? Okay, who got the bail money? So your expenses must have a business purposes, okay? You're in real estate, your business purpose is to buy anything you need. It has to be a business purpose. For example, if you go out somewhere and you're going skiing and you think you're going to deduct it, you're probably not going to deduct it. It can be, and we can show you how it can be. A portion of it can be deducted, but all of it is not going to be deducted because your main purpose was to go skiing. Okay, so no, you cannot deduct that. And just because you made a phone call to your real estate person or whatever that day, it is not deductible, just so you know. And then it has to be ordinary. That means typical in your industry. I have a clients that are in the film industry and they get to deduct their movies when they go to movies. That is typical. They do films. They need to at least see lighting and how it's done and stuff like that. You're a real estate person. Do not say you're going to go and write off the things that you do for film when you go to the movies because you're looking at something on real estate. It's not going to work. Also, if you're going to do deductions, they have to be profitable. Necessary, that means profitable. If you're going to a seminar, and the seminar is on section 1205, okay, 1205 says that if you are a C corporation and you've had that C corporation for 5 years and you decide to sell it, you can deduct about $10 million, no taxes. You go to that seminar, you can't deduct that. I can. You know why? Because it's profitable for me, but you can't. So you get what I'm saying, guys? When you do your deductions, make sure it has something to do with your business. Documentation. Documentation is like real estate. Location. You got to document. Next slide, please. Missing something. Okay. So let's talk about depreciation. When you buy, you're with your accountant, most accountant, when you buy a property, they say 20% on land, you have to depreciate it. Everybody here know what depreciation is? If you don't, let me tell you, depreciation is another gift from God. It's the IRS says to you, we know you bought an asset that's going to appreciate, and that's the reason why you bought it. But we're going to tell you that, no, it's not going to depreciate. We're going to tell you how much you can take off every single year that reduces your taxes. Reduce your taxes is always good. So anyway, so you get the land, and by the way, it's missing some information, but don't worry about it, I'll talk to it. You get the property, it's $100,000, whatever. You put 20% to land, you put the next 80% to building, and then you depreciate it between 7.5 and 39 years. 27.5. 27.5 is for residential, 39 for commercial. That's a long time, okay? It's a very long time. But what if we talked about cost segregation? Anybody hear cost segregation? Great. Cost segregation says you bought that land, building, and we know that you bought the building, but not everything in the building is for building. It doesn't go underneath the IRS codes. So in there, we can carve out stuff. And what I like to think about it is you take your building, you turn it upside down, you give it a good shake, and whatever falls out, we can possibly depreciate quickly, accelerate depreciate. So we get cost segregation. Instead of just doing the building, what we do is we take the land. Land is never deductible, by the way. So you assign 50% to the building instead of 80%. Then you go to the contest and you do maybe 100%, and you do section 179. I used to talk about bonus depreciation, but bonus depreciation every single year, it's getting less and less. This year it was 80%. Next year I think it's going to be 60. And then you do the land improvements, the fence, whatever it is that you may have done, and you do that to assign maybe 10% to that. And by the way, missing something. So if you had saw what was up there, you would see that when I did the first example, you only got like about $10,000 in depreciation. You do segregation, you get $145,000 that you can then deduct off of your income. Does that sound like magic to you? Hey, raise a hand. It's magic, okay? Flip the next slide. I'm looking at the slide because I'm going to see what's missing. Okay, so let's talk about how does that mean to you? What does that mean to you? So you say you're in the 40% bracket, federal and state, okay? And you buy this asset for, I think it was $500,000, my example was. $500,000, you do it underneath 40 years, I'm rounding, 40 years, and you get $10,000 worth of depreciation every single year. You times it by your 40%, you get deduct $4,000. That's $4,000 of income in your pocket that you can then buy another asset. $4,000, nothing to sneeze at. But I just showed you how you can do $145,000. So you take that same $145,000 that I gave you, times it by 40%. What number is this, ladies and gentlemen? $58,000 that you just got. I said, God, oh my gosh. The government just gave you in your pocket to invest in another asset. You see how the rich do it? They take that money. They do the cost segregation. Cost segregation usually give you about 30% of whatever the value of the house or the property is. You take that money, you put it in your pocket. You take it out of your pocket, you go put it in some another asset. Works well, right? Next slide. There used to be something, I'm not sure what's going on. Like-kind exchanges. No, go back. Like-kind exchanges. I love like-kind exchanges. What like-kind exchanges says is that you bought a property 10 years, 5 years, 3 years, whatever, you liked it then, you really liked it then. But now it's 10 years, you don't like the neighborhood, you may have moved out of state, whatever, and it's appreciated. It's appreciated 50%, okay? So you could go and sell that, and you could have capital gains, depending on what tax bracket you are. Or you could do a like-kind exchange. And it says, you can take this property, and you could go out and find another property that you like, better property, more money, because one of the things is it has to be more expensive than the one you're giving out. And you roll that thing over into another property. You don't pay capital gains. You don't do anything. You just roll it into the next property. What this doesn't show is that what like-kind exchange can do is that you may have one property, and you decide that I'm doing well with one property, but I want to do more because I can get more money. You can now take that one property and buy 3 properties. The only requirement is that it is more expensive than what you have right now. And I shouldn't say only because it's very intense. These are not DIY things that I'm telling you about, guys. You have to be with a CPA. Cost segregation, it has to be an engineer. Like-kind exchanges, you need a trust. It's not just do it yourself. The other thing about like-time exchanges is that you can now take that property that you rolled into 3, take it later on, maybe you roll it into 4, maybe you roll it into a triple net lease. We all know what triple net lease are, right? Okay, but guess what? You don't pay capital gains, and you wash, rinse, and repeat. And the only time it's going to come to bite you is when you're dead. Okay? Then your heirs have to worry about it. No, they don't. Because you know what happens when you die in most cases? You get a step-up in basis, baby doll. Do you know what a step-up basis is? A step-up in basis? Great. For those who may not know, it means that when you bought that house, it was $10. And over the years, you've rolled that gain, you've got it increase in price, in value. But when you die, that value just goes right up to it is. We don't worry about what you paid for it. So your heirs don't have to pay taxes. Wash, rinse, and repeat. What does the rich do? They wash, rinse, and repeat. And that's what you got to do. Next slide. Debt. Debt is a wonderful thing. Not everybody thinks so, but it is. It can be if managed well. Debt is tax-free. That means you're using somebody else's money, OPP. And you're using it to get ahead. You don't have to pay for it. It's not yours. You don't have to, all you have to do is pay it back. And if you're making money, you'll be able to do that. Interest, you get interest. That's deductible. But the great thing about debt is that it amplifies depreciation. In my example, and I apologize for the slide, in my example, say you had $200,000, you took it out of your own pocket. No, you want to use somebody else's money, by the way. But you take it out of your own pocket and you invest it. You ain't got no more money, first of all. Second of all, you can take a Section 179 deduction. Everybody know what a Section 179 deduction is? Okay, for those of you who don't know what Section 179 deduction is, that means that certain category of assets, normally you have to, general rule is you have to depreciate, take a portion of it every single year. 179 says you don't have to do that. You bought that refrigerator, you just deduct it on your tax that year. So you take 179, you get times it by 30%. You have $60,000 that you can deduct on your taxes, right? Sounds good. But what if you decided that you wanted to borrow that money? You have the cash, you borrowed $800,000, you invest $1 million, you won Section 79, 30%, you've got $300,000 that you can deduct on your tax. That, by the way, by 40% is $120,000. You have just saved, the government has just given you can buy another asset. Wash, rinse, and repeat. Next slide. I am not sure what's going to, on this slide, I was going to offer you and tell you guys how to get in contact with me, and there was going to be a Q code that you can sign up for Tom's weekly newsletter that tells you all the things I'm telling you, tells you how to do it, and everything you need. I'll make sure I'll get that out somehow to you guys, maybe in an email if you signed up, and so you can know that. So I did my 15-minute really quick thing, but do you have any questions? Any questions, anybody? Yes. Okay. Section 179 for vehicles. There is a rule that says if your vehicle is more than I think it's 9,000, 6,000. I was going to say 6,000. 6,000. You are able to write off that vehicle using 179. However, let me just say that that vehicle has to be used 100% to do 100% of it written off. So if you only do it 50%, you're only going to get 50%, but you can write that portion off. And it's really, really good. So if you have two vehicles, make the ones that you only use when you are doing your real estate. So think about it like this. If you bought a vehicle at December 1st, you bought it for, I don't know, $80,000. And during December, that month of December, you wrote it only for your business. It's tax deductible, all of it, because guess what? The substantial amount, the amount that you wrote for at that time, is 100% business. Everybody understand that? Got it? Anything else? Thank you for reminding me.
Oh, okay.
What you have to do more than anything else is have good financial records. And I'm serious about that. Everything I just told you, if you don't have a good bookkeeper, your bookkeeper is your friend. If you don't know what's is happening in your business, you cannot tax plan. And if you tax plan and you get audited, you will lose your shirt. You can't have cost segregation if you don't know how much you paid for it. And you don't have to do cost segregation the first year. You cannot have debt if you can't depend on the financial. When I was growing up, and I'm pretty old, by the way, we used to have this thing when we did computers, garbage in, garbage out. If your financials are not good, you got garbage. Think about it when you buy a house. Your foundation, you're going to inspect it. If it's no good, are you going to buy the house? So what are your financials? Your foundation. The cost segregation actually is in 1 year. And I'm missing some slides, and now that you remind me, I'm going to talk to you about that because I don't see the slide there. Cost segregation, you can take the deduction in 1 year if you have the income, okay? If you don't have the income, you can roll it over. So one thing I want to tell you is that I told you that government does not think that you are a business. That means you're passive. You're passive. You have passive losses. Passive losses can only be deducted against passive income. So if you don't have enough income, your cost segregation you won't be able to use in that year, but it can flow over. But there's things you can do to mitigate it. And with that said, I'm remembering because the slide is not there. Almost every single activity that you have that's rental is passive except for two. Flipping is not passive. You will have to pay self-employment taxes. Remember I said you don't have to pay self-employment taxes with real estate? Flipping you do. And if you have short-term real estate that you do substantial services. Anybody know what substantial services is? Raise a hand. Okay, great. Substantial services mean that you have short-term, and 99% of you people will never do this. You have short-term rental, and you offer substantial service, which means that you pick up the person from the airport in a limousine or a car. You give them a car to ride around while they're in the city, okay? Or you get a chef that feeds them every time they need food or whatever. That's substantial services. You will never have, you will have to pay self-employment and taxes on that. And the short-term rentals, because the slide is missing, I'm hearing it in my head now. Short-term rentals although it is passive income, all your expenses can be deducted when you do short-term rentals. That's a great thing about it. So you were talking about cost segregation. If you have a house and you bought something and you do cost segregation, you will be able to deduct as much as you can until we reach what we call the business credit loss limit. You'll be able to deduct it. Anybody else who is in long-term or any other real estate that they hold, you have a cap because you're passive. So you can either become a professional real estate investor based on the IRS code, which is simple when I tell you and very hard to do in reality. To be a real estate professional, you have to work at least 750 hours in your real estate. You can group them if you need to. That's another section we're not going to go really deep in. And once you work 750, that's your first hurdle. But you also have to work, you cannot work more hours in any other venture that you have. That means if you have a job, you will not be able to be a professional investor. If you have another business, you'll not be able to do that because you have to have most of your time in that real estate. So what do? Okay? If your income, your AGI, adjusted gross income, is less than $100,000, you're able to deduct 25% loss, $25,000 in loss. But as you grow, that's not going to help you. And on that note, as you grow in your AGI up to 150, that $25,000 goes down. So by the time you get to $150,000 in just your gross income, you have no loss that you can take. So what do? You can go back to short-term rental. Or if you are married and your spouse is a stay-at-home spouse, you can possibly become he or she can become a professional real estate because on paper, they don't have any other activities. And then you can also do what we call a pig. You create a pig. It's called a passive income generator. That is way, way over this class, this seminar right here. And it involves a lot of shifting around and a change of mindset. Tom says change your facts, change your tax. A pig is one of those items that you will do. And it goes against your passive losses. Any other questions?
You guys have like a really interesting calendar in your life. It gets real busy around certain times of the year. Would you just walk us through when's a good time to engage you? When's a good time to catch you on the, where you have a lot of time to focus on a particular person's, financial planning?
My business is not geared around the regular one, so any time is really good to engage us, and you should engage us before you do that first bill, that first purchase. Financial planning is definitely step by step, and it builds on each other, and any time is good. And like I said, I'm a franchise. If I can't do it, there's somebody else that can do it, that can help you. We teach wealth as well. We teach you that to have asset classes. And your asset classes we think is gas, oil, real estate. And you choose what you do and learn what you're doing. We teach you, if you're a real estate professional, we teach you how to gear your mind to find the assets that you want, which means something like this. Tom says do a 3-minute decision when you need to buy something. So that means you got to know what you want to buy. For example, I invest in single families, homes. I don't invest in high single family homes. Okay, I invest in houses that are small, and I can rent out to people. So I know, and I also know what the ROI I want. I know the ROI. I know how much I want to pay for it. I know all that. So when a realtor comes to me and says, Vonda, I have something to buy, my realtor knows what I need. She's not going to bring me anything, and I can make that decision right then and there. And we teach you all that. Okay? But we do it from a wealth. We don't compete with Tommy. Tommy's totally, we do it from a wealth. Okay? Any questions? Okay, great. Thank you.